Ba 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 ba. What is going on? It is June 10th, and we are back at the MBS. That's Mortgage Bros Science. Please like and subscribe. This video is probably not going to be applicable to the 20 of you that actually watch. Hopefully, in the future, it's millions. But we're going to go over construction loans today, and this is my favorite. Construction loans. All right. I've said it in previous videos, but now I'm really going to hammer it home. When you go for a construction loan, you 100% need to call a bank. Now, not every bank does them because they are a high risk product because you're lending on a home that's under construction and not built yet, right? The appraised value is what's being complete and not what's there. So the collateral, a half built home, ironically, has no value, right, to a bank because you can't live in a half built home. So there's no value there. All right. So what do I mean by I have to go to a bank? When you do a construction loan, it's considered a non-saleable loan. All right, like any lender or broker, all right, they're gonna have to have saleable capabilities to go to the secondary market or to sell to a bank. All right. The beauty of a bank is when you think about it, what's a bank? All right. You give your bank money, and that bank then lends out your money. It doesn't just sit in a safe. Okay, it's not like money heist. And then they earn interest on your deposits. Okay. And this is what they do for construction loans. It's called a portfolio loan, meaning it's non-saleable. Why is it non-saleable? Two reasons. A, 29-year AM. All right. Traditionally, as we talked about, you have 30-year amortizations. All right. That's the standard when it comes to saleable loans. All right. Like 30-year fixed. All right. But a construction loan is technically a 29-year AM. Now, why is a construction loan a 29-year AM? I'll tell you why. Because they give you a year to build. Now, usually banks, they'll give you a year, 18 months, 24 months, depending on the size of the home that you are building. However, if you're building a 7,000 square foot home, you're definitely not watching my videos. And if you are building a 7,000 square foot home, I promise you, you're still going to be lonely inside that home. I don't care how nice the bathroom is. But I digress. So for all intents and purposes, they give you a year to build. Okay. So they have 1 year to build. And I want to really hammer this home. They could give you 18 months, 24 months, but for all intents and purposes, just say year to build. So you have a year to build, and then after you are done with construction, you amortize out for the rest. All right. Now this is actually, let me do this. One-time close. All right. Really want to hammer this one too. You're going to call a bank because when you build on your home, you are going to want to do the one-time close. There are reasons to do a two-step close. All right. Builders, they call it the spec loan. They also have those. But for the run of the mill, you're either buying a home, you intend to knock it down and build up, or you don't feel like moving because prices are through the moon and you're okay with refinancing out of your rate in order to get this loan. All right, so that's what we're talking about here. You already own your home, you're going to knock it down and build brand new, or you're going to add a second story addition or addition off the back, or you're going to lift your home. However your way you see fit, it's still a construction loan. All right, so it's a 29-year AM because they give you a year to build. So how does this work? All right, you're going to pay interest only for the phase of construction, making it super affordable. You're probably not going to live in your house while it's being built. All right, I guess you could if you wanted to, but that wouldn't be, camping's fun for like 5 days. And then after 5 days, you start saying, like, what the hell am I doing? Right? I can just go live in LA or something with Spencer Pratt, and that'll be a real hoot. All right. So you pay interest only based on what you draw. What do I mean by that? The construction loan works kind of like a line of credit. And then as you need more funds, you rack up a balance, increase what would be then your principal balance, and then you convert to the amortization phase and you're going to amortize out. Now, I said 30 years. You could do a construction loan on an ARM, what I recommend. But let's just say you're doing 30-year fixed and you're going to be fixed for those 29 years. All right, so let's run some numbers here. Say you owe, this is going to sting, right? Say you owe 200,000, okay? 200K on your mortgage currently. All right. And you get the signed builder's contract, you get a quote from a builder. And that number comes in, say it's going to cost you 500 to build. Okay. 500 build. Now that's all in. That's what his contractor fee of 20, 33%, whatever he's charging you. Hopefully he's not ripping you off, Shop other builders, make sure they're licensed. I'll touch on that a little later. All right. So this puts your all in costs, add closing costs in there, just to say 710. All right. Now you're thinking, oh, how the hell am I going to get $710,000? And why do I need $710,000? I'll tell you why. when you do a construction loan and you already own the home, it constitutes as a refinance, right? Because you already own it. So you're refinancing. You cannot subordinate a construction loan. This is why it's a dagger. So if you do have 2.5%, I would highly recommend exploring a line of credit depending on the size project you're taking on. But a line of credit, remember, the appraised value is going to be what's there, not what's being built. And if you tell the bank, hey, I'm knocking down the home with this line of credit, yeah, they're going to call the note because you just destroyed their collateral. All right, this is why the construction loan's, a beautiful product aside from refinancing your rate. So you have to refinance your existing $200,000 loan, and then you also need to build for $500,000. And then I rolled in 10 for closing costs. So 710 would be your amount. Now, how am I going to borrow 710? So what they do is you're going to have signed architectural drawings, stamped plans and specs, we call them. And then you're going to have your signed builder's contract. So you're going to have an architect and you're going to have a general contractor. General contracting is pretty funny, actually. They don't do any of the work themselves. They just call out to subs and order supplies and collect payments. And they make a killing. Some builders, they clean up. In my area, they're charging like $700 a foot. It's absolutely bananas. The ones that charge $400 a foot, they're like, oh, you're too cheap. And they're still making a killing. But I digress. You're all in for 710. So how are they going to value this? They're going to take your plans and specs into cost estimate. All right. They're going to see what you're building. All right. And then they're going to go off the appraised future value. So upon completion, not what's there now, in a year's time. All right. So if you need to borrow 710, you need the future product to appraise at 8875. Okay. And how they do this, they see what you're building, they see the quality of work, they take new construction into consideration, and they see homes similar that's sold in the area. Now, obviously, not every home is going to be new construction, but that'll just go off square footage, beds, bath, and maybe the size of the lot. Okay, and then they account for new construction, value is new, and then you'll have your site value, meaning just the land, and then you'll have your collateral, right? Costs of improvements, right, or the hard costs. But then they're going to use the appraised future value. The reason they can use the appraised future value, because if you already own the home for 6 months, all right, the rules of delayed financing are in play here. You get the new value, all right? So you need your appraised value to come in at $887,500. Then you could borrow 80% to get you to 710 to finance the entire build. And that includes refinancing your existing loan and financing the build. Now, how does that work? Do I just give you $710,000 and say, here you go to Mexico? No. What they do is they're going to disperse based off percentage completion. All right, remember that. It's going to be percentage completion. Okay? So how it works is there's some banks that'll give you more than 10% of the budget to start, but for the most part, especially the larger banks like US Bank, Citizens, TD, they'll give you 10% of the budget that you will receive itemized from your builder. All right. And as I referenced before, like Wells Fargo, they don't do construction loans, too risky. JP Morgan Chase, biggest bank in the world, they don't do construction. Why would they? Too high risk. So it is a real niche product. And then I won't get into the weeds of why you have to go through a bank for this. Like Fannie and Freddie technically do have a construction loan, but trust me, it's not nearly as good, and your rate's going to stink, and you might have to refinance out. So you want to make sure it's the one-time close product. Now, what do I mean by that? Okay, that means after you build and you get the C of O, the certificate of occupancy, you're going to convert out of the construction phase into the amortization phase with no second closing. So you do not need to pay closing costs again, and your rate is secured. I remember we were ripping out construction loans like during COVID out the wazoo. Like people were getting like $2 million loans at 2.5%. It was absolutely bananas. That's why banks were going under, right? Long-term money there. And rates started ticking up. They're like, is my rate locked? I'm like, yep. They're like, are you sure? I'm like, yeah, it's the beauty of it. So by the time they were done with construction, the rates were probably 4.5, and they're still locked in at 2.5. It was actually beautiful. Okay. So you're going to be locked in, all right, for the phase of construction, and then through the amortization phase when you convert, when you get the certificate of occupancy and the home is complete. All right. So back to the draw schedule. I was kind of all over the place there, and I know my wife tells me to talk slow, so I will continue to talk a little slower. And you forgive me, I went out last night, and I'm feeling a little slow as it is. We go by percentage completion. All right, so we have a draw schedule. At closing, you're going to refinance your existing loan, and then you're going to get 10% of the build. So we're going to give you $50,000. You're like, oh, Ryan, $50,000, that might not cover all my deposits. Right now, you got to place, since COVID, they don't keep windows in stock anymore. You need to order them. All right, so you probably, to keep the build moving, will have to come out of pocket and then make yourself whole at the end. So what do I mean by that? If you can't satisfy a $100,000 deposit to your builder, you only have 50, shell out another 50 yourself, and then reimburse yourself with the loan when percentage completion allows it. So I like to say, as the builder goes, we go. All right. What would happen is anytime you need more money, we send out an inspector at your whim, and you say, hey, I need more money, order the inspection. The inspector goes out, it gauges percentage complete, footings, foundation, frame, sheathing, maybe some rafters, maybe some rough plumbing, maybe some rough electric, and so on and so forth. And they start checking stuff off. And you can order as many or as few inspections as you like, depending on how badly you need the money and how many funds of your own that you're going to use. Highly recommend. You're okay with coming out of pocket on your own and just making yourself whole. It's a lot easier that way. But if you need to use the bank's money, just know it might take you a little longer to finish the home, but it can be done. All right. So we're going to go by percentage completion. You're going to get an inspection every time you need more money. They're going to gauge what the builder has done, and we only credit for what the builder has done. So if the windows aren't installed, if they're sitting on the front lawn, you ain't getting that money. If same thing with the sheathing's not on the roof, you ain't getting that money. So we only give you credit for what the builder has completed, percentage completion, not percentage delivered on the front lawn. Okay. Anyway, and you complete this process, and we disperse funds to you, sometimes directly to the builder, as long as you, the homeowner, the person who's getting the money, authorizes it. We can give the money directly to the builder. So it is a pretty seamless process. It's just, trust me, there's going to be headaches, especially when your wife wants to redo the kitchen 18 times. Just picking tile, for goodness sakes, is a nuisance. And then there's like a million different types of crown molding. And when you build a house, you'll see what I'm talking about. But yeah, we're going to go by percentage completion, and we're going to disperse funds accordingly to what the builder has completed. All right. So say you're halfway through the build, all right, and you're paying interest only. What happens is your balance is going to grow as you draw more money. All right, just like a line of credit, but it's not a line of credit. It's a construction phase. Your payment's also going to increase. All right, so they're going to be like, oh, Mr. Ryan, like, what's my payment going to be when I draw $400,000? And from there, I'm like, all right, say at $400,000, I just do the interest only payment. Say it's at 0.05625 divided by 12. Yeah, about $1,875. And this is brilliant, because then you could go live in a super nice condo on the beach, and life's good for a year until you got to move into your home, and then it takes longer, and then your taxes go up. That's the big one. All right. So when we qualify people for a construction loan, we got to be really realistic with the taxes, because you got to make sure you still qualify, right? A hard one is when you bought a home and you go through the process, and then you don't realize that you have to carry your exit home and the fully amortized loan. It's not like you could carry just the interest only portion of it. You got to carry both loans. All right, but for this example, we're just going to say that you already own the home. You're just building on that home. There's no second home involved. All right. So we disperse percentage completion, and the first lien must be refinanced. All right. Right now, pretty much all the calls we're getting are for construction loans. Not that there's actually a lack of inventory, right? The amount of sellers is actually outnumbering the buyers right now. It's just people are just, greedy, and they just want to sell their homes for egregious amounts, and then people are like pissed off, I'm not paying that. So instead of moving, going through those headaches, everyone's just adding on to their homes, or building a brand new house, or fully renovating the interior of the home. And I would too. I mean, you already own the home, you have all that equity, make it real nice, and you're just comfortable living there. But I digress. So it's super easy to, depending on when you bought the home, like if you hold it for 6 years, there's no doubt in my mind your home will appraise, and you'll get all the funds you need to build the home. And then you're off and running. You just got to make sure you have a good builder. What do I mean by a good builder? And this sounds like common sense, but you'd be amazed. There's builders out there that aren't licensed that are trying to build, and banks, if you have insurance, sometimes they let it slide, but they want to see a license, right? Usually with a builder's license comes with some form of warranty called a 210 warranty. At least in the state of New Jersey, they have one. Other states, they do, or of sorts. I think, ironically, of all places, Florida, you don't need a license to build, and they don't come with the warranty. It's actually bananas. Double check that, though, but every state's a little different. So just check. Make sure your builder's licensed. Make sure, obviously, it's a good reputation. Make sure he's not price gouging you, price per square foot. And make sure he's not going to take the money that we give you to finish the home and run to Mexico. Believe it or not, that happens. You have builders that rob Peter to pay Paul. They use one job's money to pay for a separate job. All right, so you want to do your due diligence with builders, and the best part about construction is there is never a rush. All right, people are like, oh, I gotta get built, gotta get built, gotta get built. I'm like, well, they say Rome wasn't built in a day. Yeah, your house, it's not even Rome, and it's not gonna get built in a day. I promise you. So you're probably gonna end up using the full 12 months, all right, depending on how big of a home you are building. Now, if your home gets built in 9 months, and you can move in and get the C of O, but you don't have to tell the bank. You can continue to make interest-only payments if you want. So that's pretty cool. All right. And then you only amortize out on what you use. Say you borrow 710, but then you're like, I'm going to actually sell some stock and not use the full 710. Say you only use 410. You use 300,000 of your own funds. Well, you only amortize out on what you use. Remember, because this number is a little ambiguous, right? We don't know what you're actually going to borrow. This is just what you qualified for and what you can borrow. That's what your line for the build is. But if you only use 410 of that versus a 710, you're going to amortize out over 410. And this happens all the time. People think they're not going to use their own money, and then they start thinking about the payments and how comfortable they want to live, and they're like, well, I don't have to buy a house anymore, so what am I saving for? Let's just keep my monthly cash flow good, have lesser of a mortgage, and we'll go from there. All right, so there's a lot of variables with a construction loan, but they really are favorable, especially when you don't feel like buying a new house that probably you're going to renovate anyway, because some boomer's selling and they still have the wood paneling on the walls and old couches and old curtains and stuff and baseboard heat like I got. It's, you're going to renovate it anyway. Why not renovate your own house? Assuming you like the lot and whatnot. All right. So when you go for a construction loan, just know that, say you do have a 2% rate and you can't get the full amount you need to build with a line of credit, then you'll have to refinance out of your 2.5% rate and refinance that existing mortgage. Or I say lien. Lien has a negative connotation, but a mortgage is a lien on the property, right? The bank owns it until you pay it off. So you got to refinance that existing $200,000 mortgage, and then you're also going to obtain the funds to build. We're going to disperse these funds based on percentage completion. As the builder goes, we go. You're going to make sure that your builder is licensed. If he has one, you're going to make sure you're at warranty because the house is going to settle. Drywall screws are going to start popping. You want to make sure you get those back in and he's not just taillight guaranteeing you and he's gone. He's in Mexico. All right. And then at the same time, you're going to have what's called builder's risk insurance. Now, builder's risk insurance is different than homeowner's insurance because homeowner's insurance is for a home that's complete. All right. State Farm used to have a good policy. It was dwelling under construction. And now State Farm is pretty much an insurance company that doesn't want to write insurance anymore. So I don't even think they do builder's risk anymore. I think Zurich is a pretty good company. Zurich has good builder's risk dwelling under construction policies for cheap premiums. But I've seen builder's risk cost like $10,000. That's $10,000 for a year. It's absolutely diabolical. All right, so you're going to have builder's risk insurance. And you're like, oh, Mr. Ryan, why do I need builder's risk when my builder has builder's liability? All right, liability. Okay, it's builder's liability. So my example is builder's risk covers non-working hours. Builder's liability covers the subs and anything that the builder may do in error. Like say he doesn't connect the gas line and the home ends up blowing up. All right, so that's like say 9 to 5 working hours. All right, builder's risk covers you. Say kids are playing on the job site, they're drinking, they get hurt. It's essentially liability coverage for your property, not during working hours, and it protects all the supplies that you ordered. Say the windows come in, they're all cracked. Okay. More often than not, the liability will cover that. But if you get into a pissing contest with your builder, the builder's risk will cover that, and then you'll get reimbursed for the windows. And you'd be amazed how often stuff gets damaged. Actually, you're probably not amazed. You've seen at Amazon people just throw fucking packages. So you'll be amazed how much stuff comes in and it's already like dented, broken, and then you got to return it, and then it delays things. All right, so there's concrete, and there's concrete that will crack. And that's a good rule of thumb. So you're going to have builder's risk insurance. All right. Call Zurich. That's the one on the top of my head. And builder's risk insurance is also a niche product, kind of like, construction loans go with a bank. Not everyone's going to offer them. All right. So, it's going to take some time to find the right builder's risk quote for you, but you need it. So you're going to have builder's risk insurance. The builder is going to have a license, hopefully, offer you a warranty, hopefully, and builder liability or general liability. This covers his subs during working hours. And anything happens to the home during those working hours, the builder's insurance covers that. Right, and if he has employees, he'll probably have some type of disability, worker comp, all that good stuff, right? But you don't need to worry about that. Just make sure he's licensed and insured. All right. So it's the one-time close product. You're definitely going to need to call a bank. Start with your local bank and then work your way up. The larger banks, they might not be as flexible, right? Again, it's a high-risk product, all right, but they're probably going to have better rates on a construction loan and a lot less fees. Some banks, they're capped at like $3,700 for just the fee for a construction loan. And then you have other banks, they charge you a half point and there's no cap. So if you're building $1 million home, you got to pay $5,000, right? Just in fee. Right? We've seen it where it's $2 million home, you got to pay a $10,000 fee. It's crazy, but you consider it like an extended rate lock or a servicing fee during the phase of construction because you got to monitor the inspections, make sure the home's getting built on time. Now, on time, that's very important. If you go over your allotted time frame, whether you do 12, 18, 24, however many months you signed up to build for, if you go over that, they'll start charging you penalties if you extend. And they might just start amortizing you if you go over that building time. So then you can't draw any more money. You're paying principal, and then it's really a race to get to the finish line because you need to get the home built. Or else they could technically foreclose on you if the collateral is not finished yet in the covenant that you signed. And this will all be in your closing docs. Okay. Do you need an attorney with a construction loan? I would recommend it in case you do get in a pissing contest with your builder. All right. And he takes your money and he goes finishes another job, and then that job doesn't pay him, and then he can't order the deposits or the supplies that you put deposits on, and then your money's going elsewhere and he doesn't have money to reimburse your own job. So you can get an attorney for a construction loan depending on how well you know the builder. Ironically, the better you know the builder, the more I see fit to have an attorney, because it's always family and friends. That's where all the hardship happens. Every time you do a loan for somebody that you kind of know, there's just something out of God's grace. Something always happens. It's diabolical. It just blows my mind how often that works. But a complete stranger, everything rolls fine. It's weird, God works in mysterious ways, and I'm referencing God a lot right now. All right. So you're going to take, back to how much you're going to borrow, you're going to take 80% of the appraised future value. That's the home upon completion. How do they get this number? They take the plans and specs, builder's cost breakdown, itemized. They see what you're building, type of home, homes in the area that is sold that are comparable, and then they give you more credit for being brand new construction and the type of work that you're putting in. And that's how they're going to come up with the appraised future value upon completion. And that's where you're going to be able to borrow against. Because you might be like, oh, well, right now my house is only worth $500,000. How the hell am I going to borrow $710? Because of the appraised future value. All right. And it's the one-time close. So at the end of construction, you do not need to refinance out. Now you can refinance at any time. Really, they don't like to see a refinance out of a construction loan to get another interest only. But circumstances happen where you can refinance a construction loan into a construction loan. But let's just say you're going to finish the home. All right. Don't beat me up too hard on that one. And then you're going to convert to a 29-year or 28 and a half, 28-year amortization, depending how long it takes you to build. Then you begin to pay payments from there. So you could choose a 30-year, 20-year, 15-year. You can choose the ARM. That's what I recommend. But you'll be able to finance the entire build. It's super important that you're willing to at least come out of pocket a little bit with your own funds. This way you keep the build running, you get the deposits ordered. And if the builder's not waiting on you, you're not waiting on the builder. All right, so there's more moving parts here than just the run-of-the-mill, either refinance or buying a home, but it's worth it when you can see your brand new home customized to how you like it. Now, it's not for the faint of heart because there's so much more that goes into it than you would think. Like the tile, the fixtures, like doorknobs, right? Trimware, crown molding, what type of appliances. Should you go GE or get those special ones from Italy? They're all the same. Types of windows. All right, you got Pella, you got Okna, you got Andersen windows. Andersen's in bed with everybody too. Andersen really capitalized on the market. Biggest advice for a construction loan, if you have a yard, you undervalue how much fences cost. So when a builder offers to put the fence in, believe it or not, a lot of new construction, they don't come with fences or decks. Ask that as an add-on, because it's better to finance that $30,000 fence over 29 years than it is for you to close on a house and have to shell out another $30,000 for a nice white vinyl fence. So that's my tidbit. Get the deck, get the fence. But that's construction loans in a nutshell. I'm trying to think if I missed anything here. No, it's the one-time close. You got to refinance your existing rate. We disperse funds based on percentage completion. And you definitely need builder's risk, and you want to make sure that your builder is licensed and insured. I know that sounds wackadoodle, but you'd be amazed how many builders try to get by without having a license. And then you'll deal with an architect and do all the drawings and stuff, right? The GC will probably recommend an architect. It's actually pretty funny. They always say, oh, such and such custom homes. And it's funny because they just build the same house or a variation of the same house 6 different times and say it's a custom home. Like, no, they just have these set plans, and you could, tweak, say, the closet size or the one master to a bigger master or something like that. So it's not really a true custom home. They just say custom homes. Like, what? I guess you could do a modular home. Forgot about that one. Modulars, they're just made out in like Pennsylvania, and they literally just ship your house like Legos, and then you just put it together. All right, but you're not going to get percentage completion until it's connected, right? Real estate has to be attached to the footings, to the foundation to get credit. But people do modulars. It is quicker. Call them prefabbed homes, but I would just do a stick build. nicer, sturdier, looks better, it's funner, but however you see fit. So yeah, appraised future value, one-time close, interest only during the phase of construction. You'll get your insurance, and as always, you're going to collect all of these documents. And this is important because on a simple W-2 purchase, maybe you don't need tax returns. I guarantee you on a bank portfolio loan, they're going to want to see tax returns. So you definitely need everything PDF format. And construction is going to take some time. So you're going to call your banks. I talk to people like a year before they get started, right? Because they really got to set the foundation, pun intended, and then get going. Because it takes a while, whether you got to get a variance or building permits, or you get the environmental and there's some septic, or anything can go wrong. There's like engineering. Some people try to get away from new home build taxes by just keeping 3 walls up and the foundation, and then the engineer comes back and is like, hey, this foundation's so old you can't possibly put 2 stories on this, now you got to start from scratch. And everyone's up in arms like, what do you mean the foundation's old? Like, well, the foundation's old, it's from the 40s, it's cracking, right? Concrete that will crack, it happens. So you definitely get all your documents in order and call around the banks, see about their one-time closed construction loan. We call it construction to perm, C to P, however you want to call it, all in one construction loan. And yeah, you'll be on your merry way, and you're going to lose your 2.5% rate, but you're going to be happy because you got a brand new home. So that's Mortgage Bro Science construction loans in a nutshell. Drop a comment if I missed anything. Again, it's not rocket science, but these are products here. Different than a 203K loan. I'll make another video about 203K loans. I see the need for them, but that's one of those loans like the FHAs where it's a government, and anything with the government stinks. So just do the one-time closed portfolio construction loan, not a 203K loan, and yeah, you'll be real happy. Please like and subscribe and share this video with anybody who might find it useful. Thanks.